Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Fundamental global macro events drive international capital flow. Real reasons to move money over time will sooner or later play out. There's no doubt there's a lot of short-term technical factors, and there's key levels that dealers take things to, and then in the short term there's a lot of seemingly random movements in currency prices. But over time, if you get the key global macro events right, it's going to put you in line with the trend. And trading currencies isn't about knowing everything, but if you know one thing and you can trade with the trend, over time, if you trade with the trend, your chances of success increase dramatically. And if you know what the longer term trend is, and you can use a FX option from the ISE to give yourself time to play that trend, you don't have to be a top-notch technical analyst. You don't have to be in there every day fighting this. You can step back and see these things that you see because of your interest in the world and use the ISE FX options to take a shot at these. Take a small bet that could turn into several 100% return if you get it right, or even more if you have the patience to hold and your long-term view is playing out. And again, that's why we love the FX options for this type of longer-term view. The other key point, and this is one I think that people tend to miss, it's often talked about, but this is really critical in currency markets more so than any other markets, because the currency market is so sentiment-driven more so than other markets, because there's so many doggone factors out there that people attach to why the price is moving. You get these sentiment-driven, self-feeding trends. Markets overshoot in currencies more so than others. Obviously, you see overshoot in currency market in other asset markets. The NASDAQ, when it broke in 2000, most people watched that NASDAQ going up in 1990, those stocks going up, and we said, boy, this is going to end badly. We just don't know when it's going to end. Same thing in currencies, but even more so because of the fact that they're so hard to analyze, and because people miss the stuff going on underneath the surface, this supply and demand of capital flow going on underneath the surface. Because they miss that, they tend to be fooled a bit. Self-feeding trends. We see this in every time frame in the currency market more so than other markets. In the minute time frames, in the intraday, in the daily, weekly, monthly time frames. It goes like this, just to put it in a nutshell to explain it. I think that the US dollar is going to continue to crater against the euro, because the euro is going to become the world reserve currency someday, very, very soon. So I put money into the trend, and I'm right. The euro starts to rally against the dollar, and I say to myself, wow, the world reserve currency rationale is making a lot of sense. I'm going to add some more money to this trend. Others get a hold of this rationale. It's repeated 1,000 times on CNBC. And more money comes into the trend. So we have a self-feeding, sentiment-driven trend that isn't based on reality, but based on sentiment and perception of reality. It doesn't matter. Perception and expectations is what drives real people to put real money into trends. And if they get it right, they add to the trend. You see that in currency markets more than other markets, and you get that self-feeding. It's a great thing when you're riding the trend. It tends to go further, and it's a great thing if you're out of the game and you're watching and you're looking and you're seeing this extension, this incredible extension based on these rationales that don't make sense. If you're out of the trend and you're outside these rationales, you have a much easier, it's always easier for you to look at it more objectively, and you can say this is a silly rationale. But it doesn't matter. Rationales can go on and play out longer than we think. But sooner or later, the fundamentals will turn and drive this, and that's when you want to start positioning. So understand sentiment and overshoot is key in this market, and it will allow you to start positioning the other way when you start to look at these broader global macro events. Again, you don't want to jump in the middle of a trend and say, I'm right and the market's wrong, because their rationale is wrong. You want to wait for some consolidation, wait for some movement, wait for some people to understand that they are wrong, and see some money exiting. It's really that simple. This is is about thinking, again, just using some logic. And again, if there's any point I want to make here today is that you don't have to be a so-called, quote, a dealer desk currency trader to make money in currencies. If you're a thoughtful person and you understand the global macros, using the FX option product in the ISE is a great way to make money in currencies. And I'd say it's a lot more stress-free way to make money in currencies than in there every day. We do it both ways. And I'll tell you, trying to be in there every day, fighting the dealers intraday with trades is a heck of a lot harder than this. And ultimately, over time, we've also found, when we step back and look at our trades, the trades that we put on with really good rationales in the options markets have often, most all the time, turned out to be much better trades than fighting intraday against dealers with our technical analysis. So keep that in mind. Trying to sum this up to a little bit about how currencies, I tried to say what's the nutshell of how a currency movement is, if I had to just kind of repeat some of what I said there. Shifting of the massive pool of global capital. Money has to move for a lot of different reasons. It moves for return, it moves for fear, it moves to fund real goods. Keep in mind, the currency market isn't out there as just a speculative market. Most of the money traded in the world currency markets is for real products to lubricate global trade, globalization. That's why these markets have gotten so big. We have a more globalized world trade, and because of that, money, the currency markets need to facilitate that trade. So that is number one. It's not a pure spec market. We're playing it for spec and trying to make money, but there's pools of global capital that move for other reasons than the speculative players may expect. So keep that in mind. You don't always know. There are only a few reliable indicators, and I'll give you the two major reliable indicators in just a moment. And because there are only a few reliable indicators over the long term, it explains why currencies are so difficult to forecast. And again, because they're so difficult to forecast, you tend to get sentiment, price-led, self-reinforcing markets that lead to that overshoot. That's different than stocks and bonds. Stocks and bonds, definitely you get overshoot, but you don't get it in the way you get it in currency. So keep that in mind, and you can use that to your advantage, which means if you're in a trend, you can try and squeeze a little more out of it because you're going to tend to get overshoot. And if you're not in a trend and you're looking to go the other way, you're going to be able to enter probably at a better price than you thought if you have some patience. And patience is also key when you're thinking about long-term trends. And again, to break this down so you can just conceptualize this from an analytical framework standpoint, which is how we do this. We really look at these three baskets. And again, I'm showing you these three baskets to show you that you can use this type, you can weave your fundamental analysis, your sentiment analysis, and your technical analysis together. Again, if you're just a pure technician, I understand that, and you've had success, that's great. But if you're not a pure technician and you're still developing a way to go about analyzing currency markets, I've tried being just a technician over the years. It just didn't fit me. I found when I started to layer on fundamentals and some sentiment analysis in the long term first, intermediate term, and then short term, working from the kind of a macro view down. I found I was much better at my technical analysis when I entered this market with a market view, weaving the fundamentals. So that's how this approach came about. Fundamentals. As I said, there's really only two. Over time, there's only been two major drivers that you can hang your hat on in the currency markets. Consistently hang your hat on as the drivers. Interest rate differentials. What is the relative rate of a currency yielding compared to another? Everything else being equal. Economic growth the same, risk the same. The currency with a higher yield is going to tend to do better. The reason is, there's a big pool of money floating around the world that's constantly looking for high return. This is what's called hot money. If you hear this term, hot money, it's money rushing into countries and currencies, often to get just to sit there and deposit short-term deposits and garner a higher interest yield.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.